Welcome to the deep dive. We're here to try and navigate this high-tech, high-risk maze that modern finance has become and really turn it into something clear, something you can actually use. Because, let's be honest, looking at the markets today, it often feels, well, overwhelming. Almost like watching, flying robots trading at light speed. You just can't keep up.
That feeling isn't accidental. There's a lot of, let's say, deliberate complexity out there. And when it comes to investing advice, well, everybody seems to have an opinion, right?
Oh, absolutely. Every corner you turn.
But very, very few have a proven track record, a sustained one. We get bombarded by pundits, talking heads. They talk the talk, but haven't really walked the walk. So our mission today, cut straight through all that noise. We're skipping the fads, the hot tips. We're going right to the source, the timeless wisdom from the masters of the game.
Masters. Who are we talking about?
We're talking self-made billionaires, Nobel Prize winners, the real financial titans, people who built fortunes using consistent, proven strategies, not just luck.
Right. So we're digging into what they know, extracting their core principles, almost like the blueprint they'd give their own kids if they couldn't just hand over the cash.
Exactly. That's the goal. To give you, our listener, a clear path. We've synthesized what we learned into 7 simple steps. Steps designed to get you towards financial security, independence, and, ultimately, freedom.
Okay, 7 steps. Where do we start? It sounds like a lot.
We start with the first piece, and honestly, maybe the toughest part of the whole puzzle. It's about locking in your psychological commitment, getting your head in the game.
Okay, so psychological commitment first. This feels important because it seems to run counter to what most financial media pushes, right? They're always talking about the next hot stock or timing the market perfectly.
Precisely. That's the common misconception. People think success is all about finding that secret formula, that perfect trade. But the masters, they tell us something completely different. They say success in this game is, get this, 80% psychology, managing your own emotions, your beliefs.
80%, wow.
And only 20% mechanics. The actual strategy, the how-to.
So even if you have the perfect plan.
Even with a mathematically perfect strategy, most people fail. Why? Because of the stories they tell themselves.
Stories? Like what?
We call them limiting stories, or sometimes disempowering stories. These beliefs we internalize about money, often without even realizing it. Things like, oh, I just don't make enough to save anything meaningful, or, the whole system is rigged against the little guy, so why even bother?
Right, or the classic, I'm not a numbers person.
Exactly.
Yeah.
And if you go into investing armed with those beliefs, even subconsciously,
Yeah.
you're sort of setting yourself up to fail.
It becomes a self-fulfilling prophecy.
Completely. You approach it half-heartedly, maybe you stumble, and boom, the failure just reinforces that negative story. See, I told you I wasn't good at this. The sources we looked at really hammered this home. These deep-seated stories are the real anchors holding people back. They're why people sabotage themselves, often right when they start making progress.
So how do you break that cycle? Does it happen slowly?
Interestingly, no. The breakthrough, the real shift, it often happens in a moment, a distinct point in time. Now, it might take years of frustration, of that quiet dissatisfaction building up, getting you ready for the change. But the transformation itself, it's often instantaneous.
Like flipping a switch.
Kind of. Something triggers it, and you just draw a line in the sand. You decide, okay, what was acceptable before? It's just not acceptable anymore, whether it's about financial discipline or lack thereof.
That conviction.
That conviction becomes the fuel for everything else.
It's amazing how much psychology impacts even our physical selves, too. It's not just about money, is it?
Not at all. There was this fascinating study, ran for 8 years, looking at adults and stress.
Stress. Something we all deal with.
Right. But here's the kicker. The study found that the adults who experience a lot of stress, and this is crucial, believed that stress was harmful to their health. They had a staggering 43% increased risk of dying.
43%, just from the belief about stress.
Exactly. The stress itself wasn't the soul killer. It was the story they told themselves about the stress. If other participants had the same high level of stress, but they didn't see it as inherently harmful, their risk of dying was no higher than people with low stress.
Wow. That's a powerful lesson for our financial lives, too, isn't it?
It's a perfect metaphor. You can actively change the narrative. Think about physical stress symptoms, pounding heart, fast breathing. Instead of labeling it anxiety or fear, the masters suggest reframing it. Tell yourself, okay, my body is getting energized, is preparing for a challenge. This is peak performance kicking in.
Changing the story changes the feeling.
And it literally changes the body's physical response. That same power, the ability to consciously rewrite your core story, that's what unlocks your capacity to succeed financially.
Okay, so that mental shift, that drawing the line in the sand, that leads us right into the first actual action. Step one, you called it.
Step one, it's the fundamental decision. You have to decide consciously to become an investor, not just a consumer.
Investor, not consumer. I like that framing.
And this whole decision pivots on harnessing something truly powerful, something Einstein supposedly called the eighth wonder of the world.
Ah, compounding.
The unmatched power of compounding. It's not just some, academic theory. It's described as the only sure way to grow your seed of money into the bumper crop you'll need down the road.
It really relies on time, doesn't it? That's the magic ingredient you can't get back.
Time is everything. And there's a great historical anecdote that just perfectly illustrates this. Benjamin Franklin.
Okay, Ben Franklin. What did he do?
Well, when he passed away back in 1790, his will had these really interesting instructions. He left about $1,000, which is a decent sum then, to both Boston and Philadelphia.
$1,000.
And the instructions were super specific. The money had to be invested, couldn't be touched for 100 years, a full century.
Wow, patience.
After that century, they could take out a portion for public works projects. But crucially, the rest, locked up again for another 100 years.
So 200 years total.
200 years of uninterrupted growth. Now, if you assume a fairly conservative historical return, say 8% compounded annually,
Right.
that initial $1,000, by 1990, it had grown to roughly $6.5 million.
6.5 million from $1,000.
That's compounding. Franklin understood time. His legacy wasn't just kites and keys. It was understanding this fundamental principle.
That's just staggering proof. It really drives home that the decision to start, the commitment, is way more important than how much you start with.
Absolutely. Which leads directly to the core habit the masters all use.
Yeah.
Creating what they call a freedom fund.
Freedom fund. Okay.
It's simple, really. You have to decide up front what percentage of your income you are going to keep for yourself automatically before a single dollar goes to rent or groceries or, fun stuff.
Pay yourself first. The classic advice.
It's classic for a reason. This isn't just about saving. It's fundamentally about buying back your time. Most people trade their time for money, right? You work X hours, you get Y dollars.
That's the standard deal.
But time is finite, non-renewable. You can always potentially earn more money, but you can never get back yesterday. One source bluntly called trading time for money just about the worst trade you can make.
Huh. I never thought of it quite like that.
So, committing to pay yourself first. That's committing to owning your future time. The goal should ideally be, say, 10% of your income, maybe more if you can swing it.
But the key is starting.
The key is just getting started. Automate it. Make it happen without thinking, even if it's small initially.
And the sources you looked at had real-world examples of this, right? People who actually did it.
Fantastic examples from totally different walks of life, proving it's the principle, not the starting point. Take Theodore Johnson.
Okay, who was he?
He ran the personnel department at UPS. Not a Wall Street guy, not a CEO, just a dedicated employee.
And his strategy.
He committed to putting 20% of his income into his freedom fund. A lot of it went into buying UPS stock, actually. 20%. Consistently.
20% is pretty significant.
It is. But the consistency, that's what paid off. Through stock splits, reinvesting dividends, just sheer patience.
What happened?
By the time he was 90, his net worth was over $70 million.
$70 million. From a personnel manager saving 20%.
He didn't need to be a genius investor. He just needed to be consistent, disciplined.
Okay, that's one end of the spectrum. Any others?
Then you have the incredibly powerful story of Osceola McCarty.
Osceola McCarty.
She worked her whole life as a washerwoman in Mississippi, never earned a huge salary, but she practiced what they called penny wisdom.
Penny wisdom meaning?
Just incredibly frugal, saved consistently, never touched the principles she saved, just let it grow.
And the result?
At 87 years old, she made national news. She donated $150,000 to the University of Southern Mississippi to start a scholarship fund.
$150,000 from a washerwoman's savings.
Her money had worked harder over time than she ever had to physically.
These stories, they really show it's the same pattern, isn't it? The decision, the commitment, the psychology matters more than the starting amount.
It's everything. You have to believe you're worth paying first. That's the foundation.
Okay, so we've got the mindset right. We're committed. We've automated our Freedom Fund contribution. What's next? It feels like we need to know what not to do, too.
Exactly. Once you're committed, the next critical step is shifting from being a passive outsider, just taking whatever advice comes along, to becoming an active insider.
An insider, meaning?
Meaning you understand the rules of the game, and maybe more importantly, you recognize the major financial myths, or, let's be blunt, the investment lies that are specifically designed, often subtly, to drain your capital over time.
Okay, expose the myths. Where do we start? What's the biggest one?
We start with the one that causes the most compounded damage, silently eating away at wealth over decades. Myth number 2, the high cost of hidden fees. Most people, they look at their mutual fund statement, they see the expense ratio. Maybe it says 1%, and they think,
okay, 1%, that seems reasonable enough.
right, manageable. But here's the shocking part, the sort of dark secret of the industry. That 1%, that's just the sticker price. It's only one fee out of potentially more than 10 different costs hiding in there.
10 different fees, seriously?
Seriously. Our sources consistently show that the average actively managed mutual fund, the ones most people own, could actually eat up 60%, maybe even 70% of your potential net returns over your investing lifetime.
Wait, 67%? That doesn't sound like a fee anymore. That sounds like...
Well, highway robbery,
Yeah.
especially compounded.
It has a devastating effect. If that main expense ratio isn't the whole story, you need to ask, what are these hidden costs? What are these mechanisms Wall Street uses to, secretly pull you backwards down the mountain while you think you're climbing?
Okay, yeah, name them. Let's get specific.
Wall Street loves confusing terms. It helps hide things. But beyond the basic asset management fee, you've got the infamous 12B1 fees.
12B1 sounds
Okay.
obscure. It is. Basically, it's a marketing fee. You, the investor, are paying the fund company to advertise the fund to attract other investors. It comes right out of your returns.
So I pay them to market their own product.
Yep. Then you have trading costs. Every time the fund manager buys or sells a stock, there are brokerage commissions and something called the bid-ask spread. That's the tiny difference between the buying and selling price that the market maker pockets. It adds up.
Okay, commissions, spreads. What else? You mentioned soft dollar costs. That sounds really fuzzy.
It's fuzzy by design. Soft dollar costs are tricky. It happens when your fund manager uses the commission dollars your trades generate to buy research reports, data terminals, other non-cash services from the brokerage firm. Essentially, you pay higher trading costs so the manager gets free research.
But it's not free. I'm paying for it indirectly.
Exactly. The manager isn't spending their money, they're spending yours. And then there's often cash drag, the performance loss because the fund holds uninvested cash. And sometimes redemption fees if you sell out too quickly. Individually small, maybe, but together.
It's death by 1,000 cuts.
Precisely. Constant friction, pulling you back.
Can we see the impact, with numbers? Make it real.
Absolutely.
Yeah.
Let's take 3 hypothetical investors, Jason, Matthew, and Taylor.
Okay. Jason, Matthew, Taylor.
They all start with $100,000. And let's assume, just for argument's sake, they all achieve the exact same gross market return, say 7% a year, before any fees are taken out.
Okay. Same starting point, same market luck.
Now, the only difference is fees. Jason is in a fund that charges him 3% total all-in cost per year. Matthew pays 2%. And Taylor found a way to keep her cost down to just 1%.
So a 2% difference between Jason at 3% and Taylor at 1% doesn't sound enormous day to day.
Doesn't sound enormous.
Yes.
But watch what happens over, say, 30 years, thanks to the power of compounding working against Jason and Matthew. Jason paying 3%. He ends up with $324,340. Okay?
Matthew paying 2%, he does better. $432,194.
All right.
But Taylor, paying just that 1% fee, she ends up with a massive $574,349.
Whoa. Over $500,000. Compared to Jason's $324K, she has almost twice as much money.
Nearly double. From the same starting point, same market returns. The only difference was the drag from fees.
That means Jason essentially has to work, an extra decade or more just to make up for the money he lost purely to fees?
That's the devastating reality. Which is why Jack Bogle, the founder of Vanguard, a true hero for the average investor, he famously said that paying these excessive fees often means giving up 50% to 70% of your potential future nest egg, half or more.
So escaping these fee factories, as you call them, what's the target? What should people aim for?
The path is clear. You have to be relentless about lowering your total annual costs. To be in a safe zone, your all-in costs, including all those sneaky hidden ones, should average out to 1.25% or less per year. Ideally, much less.
1.25% max. Compare that again to simply owning the entire S&P 500 market through a super low-cost index fund. You can do that for as little as 0.14%, 14 basis points. The difference is staggering.
Okay, fees are a huge hidden drain. Myth busted. What's next? Even if a fund is upfront about fees, which sounds rare, are they always straight about the returns they advertise?
Ah, another area where the industry plays games. This involves a bit of statistical, let's call it, sleight of hand.
Yeah.
Mutual funds, legally, advertise their performance using something called time-weighted returns.
Time-weighted returns. Okay, what's that?
It basically shows the theoretical return that one single dollar would have earned if it was invested on January 1st and just sat there untouched all year long. It often makes the fund's track record look really good.
That's not how real people invest, is it? We don't just put in $1 and forget it.
Exactly. Real investors add money over time, maybe monthly contributions from their paycheck. And crucially, we tend to do the opposite of what's smart. We chase performance, meaning we get excited and put more money in after a fund has already had a great run near the top. And then when the market tanks and the fund is down, we panic and sell, locking in losses near the bottom.
Buy high, sell low, the classic mistake.
The classic emotionally driven mistake.
Yeah.
So what investors actually earn isn't that theoretical time-weighted return. It's what's called the dollar-weighted return.
Dollar-weighted, because it accounts for the timing of my dollars going in and out.
Precisely. It reflects your actual experience.
Ah.
And the industry knows full well that for the average investor, their dollar-weighted return almost always dramatically underperforms the advertised time-weighted return.
By how much?
Sometimes by several percentage points per year. It's a huge gap.
So this gap lets active fund managers kind of maintain an illusion of skill. They can point to an advertised return that most of their clients never actually got.
It certainly helps perpetuate the myth of active management superiority, but the hard data, it tells a very different story about active management overall.
What does the data show?
Over any sustained period, think 10, 15, 20 years, something like 96% of actively managed mutual funds fail to beat their own market benchmark.
96% fail.
They fail to consistently outperform the very index they're trying to beat, like the S&P 500. And remember, these are the funds charging those higher fees we just talked about.
So you pay significantly more for a performance that is almost guaranteed to be worse than just buying a simple, cheap index fund, like that S&P 500 fund for 0.14%.
That's the brutal truth for the vast majority of active funds. You pay more, you get less. It defies logic, but it's how the industry is structured.
Okay, fees, deceptive returns. This next myth feels absolutely critical, especially for someone just starting out and looking for help. Most people, probably most of our listeners right now, assume that the person they talk to about investments, their financial advisor, or maybe their broker, they assume that person has to put their best interests first.
Right.
That advice equals trust.
That assumption feels natural, logical even, but it's incredibly dangerous. It's probably the most widespread and costly misunderstanding out there. The reality is, most people working at the big brand name brokerage houses, they aren't legally advisors in the way you think. They're often called registered representatives or maybe wealth consultants or financial consultants.
Okay. So what's the difference? It sounds like semantics.
It's a huge legal difference. They work for firms that create and sell financial products. And those firms often reward their reps very generously for selling specific products, usually the products that are most profitable for the firm.
Not necessarily what's best for me, the client?
Not necessarily. And here's the key legal point.
Oh.
A broker or registered representative is generally held to a suitability standard, not a fiduciary standard.
Suitability standard, what does that mean in practice?
It means they only have to recommend products that are broadly suitable for someone in your general circumstances, your age, risk tolerance, etc. So, let's say there's a mutual fund that pays the broker's firm a nice high commission or fee. Maybe it costs you 2.5% or 3% a year. And let's say there's also a very low-cost index fund costing maybe 0.1%. That would actually be much better for achieving your specific goals long-term.
Okay.
Under the suitability standard, the broker can legally recommend the expensive 3% fund as long as it's technically suitable for your risk profile, even if they know the cheaper fund is better for you, because the expensive fund is more profitable for them and their firm.
That sounds like a massive conflict of interest baked into this system.
It is a massive conflict of interest, which is why understanding the difference between that and the fiduciary standard is paramount.
Okay, explain the fiduciary standard. What does that require?
A fiduciary, and this typically includes independent registered investment advisors, or RIAs, is legally and ethically bound, usually in writing, to act solely in the client's best interest, at all times, in all transactions, period.
So a fiduciary cannot recommend that expensive fund if they know the cheap one is better for me.
Correct. Doing so would violate their fiduciary duty, and they could be held legally liable. Their interests must be aligned with yours.
So job number one when seeking advice is finding someone who is a fiduciary.
Absolutely. Aligning yourself with a true fiduciary is like stepping inside the castle walls. It ensures your partner's incentives are matched with yours, not with the firm selling products.
And we've seen examples where this conflict of interest has had disastrous results, haven't we?
Oh, history is full of them. Think back to the Enron scandal, a classic case.
What happened there?
Well, Enron was an energy giant. Looked great on the surface. Major Wall Street firms had lucrative investment banking relationships with Enron, their stock analysts who worked for these same firms. They kept issuing buy or hold recommendations on Enron stock right up until the bitter end, even as the company was collapsing internally.
They told people to buy or hold while it was imploding.
Some analysts were still saying buy just months before Enron filed for bankruptcy, when the stock was basically worthless. As one source put it, they recommended holding until there was literally nothing left to hold.
Why would they do that? Were they just blind?
It wasn't blindness, it was the inherent conflict of interest. Their firms made money from the Enron relationship. Downgrading the stock would have jeopardized that relationship. So the incentive structure, the conflict, completely overrode any objective advice they should have given investors.
Wow. So the lesson is, if your advisor works for a company that manufactures the products they sell,
they are very likely going to sell you those products, whether they're truly best for you or not. Always ask, are you a fiduciary? Get it in writing. Okay, so we've covered the crucial mindset shift, the need to pay yourself first, and how to spot and avoid the big financial myths and traps, the fees, the bad advice. Now we move from defense to offense.
All right, playing offense, the actual strategy.
This is step 4 in our framework, asset allocation. This is where you decide, quite simply, where to put your money, which types of investments and in what proportions.
And this is important.
It's not just important, it's arguably the most important mechanical decision you'll make. Every single financial heavyweight, we studied Nobel laureates, legendary hedge fund managers, billionaires, they all said the same thing.
What did they say?
They said proper asset allocation is the absolute key to successful investing. It determines something like 90% of your portfolio's long-term performance variability, more than stock picking, more than market timing.
90%. Just deciding the mix.
Just deciding the mix. It's about diversification, yes, but the masters approach it with a very specific structure, a way to simplify the complexity. They often use what's called a bucket strategy.
Bucket strategy. Okay, break that down.
You divide your capital not just by asset type, but by purpose, by what you need the money to do for you. Generally, we define 3 essential buckets.
3 buckets. What's the first one?
Bucket number 1 is the security bucket, or sometimes called the peace of mind bucket.
Security. Makes sense.
This holds the money you absolutely, positively cannot afford to lose. Its job is to provide certainty, predictability, which, if you think about it, addresses that fundamental human need for safety.
So what goes in here? Super safe stuff.
Exactly. Highly stable, generally lower yield assets, things like traditional bank CDs, high-quality government bonds like U.S. Treasuries, and especially something called TIPS.
TIPS, you mentioned those briefly before. Remind us what they are.
TIPS stands for Treasury Inflation Protected Securities. They're U.S. government bonds, so very safe from default. But their key feature is that the principal value, the amount you get back, adjusts upward with inflation, as measured by the CPI, Consumer Price Index.
Ah, so they protect your purchasing power from being eroded by rising prices.
Precisely. Crucial for capital, you need to be absolutely sure maintains its real value. This bucket might also contain the principal protected portion of certain insurance products, like some fixed annuities we'll discuss later. It's all about safety here.
Okay, security bucket. Got it. Bucket number 2.
Bucket number 2 is your risk growth bucket. This is where you allocate the capital aiming for higher long-term returns. You accept more volatility here, more ups and downs, in exchange for that growth potential.
This is the engine of the portfolio.
This is your main growth engine. It's where you typically hold things like equity stocks, both domestic and international, maybe some real estate, like income-producing rental properties or REITs, real estate investment trusts, possibly commodities.
Okay, stocks, real estate, commodities.
And sometimes this bucket might include more complex instruments that still offer some growth potential, but maybe with a bit of built-in protection, like those structured notes we touched on earlier.
Right, the bank debt linked to an index, offering some upside with potential downside protection, but not FDIC insured like a CD.
Exactly. More potential return than the security bucket, but definitely carrying more risk.
Okay. Security risk growth. What's the third bucket?
The third one is the dream bucket. And I really like this concept because it connects the saving and investing back to the why. It provides the emotional juice to keep going.
The dream bucket. Tell me more.
This is usually a much smaller portion of your overall portfolio, maybe 5%, perhaps 10% at most, and it's specifically earmarked for, well, your dreams, for rewarding yourself along the journey, funding those shorter-term or medium-term goals that make life enjoyable.
Like what? A big vacation, a down payment on something fun.
Exactly. Maybe it's that dream trip around the world.
Yeah.
Maybe it's saving for a boat or contributing to a passion project. The point is, you need to taste the fruits of your discipline along the way. If saving feels like pure deprivation, only focused on some distant, uncertain, rainy day, it's really hard to stick with it psychologically. The dream bucket keeps you motivated. Hashtag tag 3.2 asymmetric risk reward, upside without the downside.
Okay, 3 buckets. Security, risk growth, dream. Now, drilling into that risk growth bucket, how do the masters actually manage that risk? Because that's where the big swings happen.
They manage it through a core philosophy, a guiding principle that dictates how they select investments within that bucket. It's the concept of seeking asymmetric risk reward.
Asymmetric risk reward. Sounds fancy. What does it mean in simple terms?
It boils down to strictly following Warren Buffett's famous first 2 rules of investing. Rule number 1, don't lose money.
And rule number 2.
See, rule number 1.
Right, don't lose money. Seems obvious, but easier said than done, especially in the growth bucket.
It sounds simple, but the math behind why it's so critical is brutal. Think about it. If your portfolio drops by 50% in a market crash,
Yeah.
you don't just need a 50% gain to get back to where you started. You actually need a 100% return just to break even.
Oh, wow. Right. Lose half, you need to double the remainder.
Exactly. And doubling your money takes time, precious time you can't get back. Losing big chunks of capital is incredibly costly in terms of compounding years lost.
So asymmetric risk reward is about avoiding those big losses.
It's about finding opportunities where the potential upside, the potential reward, is drastically disproportionate to the potential downside, the risk you're taking. Ideally, you're looking for situations where you might risk, say, $1 with the realistic potential to make $5 or $10, or even better, situations where you risk close to zero principal but still get to participate in market gains.
Upside without the downside. That sounds like the holy grail. Does that actually exist?
It exists in certain structures, often used heavily by the wealthy, but accessible in simpler forms too. We talked about market-linked CDs earlier.
Right, FDIC insured, principal safe, but you get some market upside instead of a tiny fixed rate.
Precisely. Your downside is effectively zero loss of principal, thanks to FDIC insurance. But you get a chance to capture some of the market's growth if it goes up. I remember one source mentioning an advisor who used these instruments heavily back in 2008.
During the big crash.
Yeah. His clients averaged something like 8% annual returns through the crisis years because their CDs were linked to a diversified index. But crucially, they had 100% principal protection. They didn't lose a dime when the market tanked.
Okay, so that's one example. What about those fixed indexed annuities, FIAs you mentioned for the security bucket? They sound similar.
They are similar in concept, but FIAs are insurance products, not bank products, so the guarantee comes from the insurance company, not the FDIC. They're often used for longer-term security goals. When structured properly, and that's key, avoiding the ones loaded with high fees, an FIA offers that same core promise, 100% protection of your principal against market loss. If the market goes down, you lose nothing.
And if the market goes up?
You get to participate in a portion of the upside based on a specific index like the S&P 500. Maybe you get 70% of the index's gain, or maybe your gain is capped at, say, 10% for the year.
And the key feature is that the gains get locked in.
That's the ratchet effect, and it's crucial. Any gains you earn in a positive year are locked in as your new minimum value. Your floor moves up.
So the elevator only goes up, never down.
Exactly. If the market goes up 12% one year, maybe you get capped at 10%. That 10% gain is added to your value, and that becomes your new starting point. If the market crashes 30% the next year,
I lose nothing.
you lose zero. Your value just stays flat at that previously locked-in higher level. You never have to climb back out of a hole. You just wait for the next upswing.
Okay, that sounds incredibly appealing for the safety-conscious part of the portfolio, but let's be balanced. What's the catch? There's always a trade-off.
There are 2 main trade-offs with FIAs. First, liquidity. Because the insurance company is taking on all the downside risk, they need your money to stay put for a while. These contracts typically have surrender charge periods, often 5, 7, or 10 years. If you pull all your money out early, you'll pay a penalty.
So only put money in here that you're sure you won't need for quite a while.
Absolutely. It's not emergency money. The second trade-off is the caps or participation rates on the upside. You don't get 100% of the market's gain. The insurance company keeps a portion as the price for giving you 100% downside protection. You're trading potentially higher returns for guaranteed safety. Hashtag 3.3, the All Seasons Portfolio, Ray Dalio's principles.
All right, this focus on downside protection, on not losing money, it leads us directly to the work of Ray Dalio, doesn't it? Founder of Bridgewater Associates, arguably one of the most successful hedge fund managers ever.
Dalio is a giant in this field. Bridgewater manages something like $160 billion, and his track record on risk management is legendary. I think his main fund only had like 3 down years in over 2 decades. He is the absolute master of managing risk through asset allocation.
And he famously challenged the most common piece of investment advice out there.
He completely dismantled the traditional 60-40 portfolio, 60% stocks, 40% bonds. It's the default recommendation everywhere. But Dalio pointed out a fundamental flaw.
What's wrong with 60-40? It sounds reasonably balanced.
It sounds balanced in terms of capital allocation, but Dalio argues it's dangerously unbalanced in terms of risk allocation.
How so?
Because historically, stocks are about 3 times more volatile, 3 times riskier than investment-grade bonds.
3 times. Okay.
So even though stocks only make up 60% of the capital in a 60-40 portfolio, they actually contribute something like 90% of the portfolio's total risk or volatility.
Wow. So that 40% in bonds isn't really balancing the risk much at all.
Not nearly as much as people think. Relying on 60-40, Dalio says, is basically just betting that stocks will always go up over the long run, which they usually do, but not always, and not without potentially terrifying drawdowns. As he famously put it, hope is not a strategy.
Okay, so if 60-40 is flawed, what's Dalio's alternative? His philosophy seems to be about building a portfolio for all kinds of weather.
Exactly. He calls it the all-season portfolio strategy. The goal is to construct a portfolio that performs reasonably well, or at least doesn't get killed no matter what the economic environment is doing.
What are these seasons he talks about?
He thinks about it in terms of 2 main drivers. Economic growth, is it rising or falling?
Right.
And inflation, are prices rising or falling? Combining those gives you 4 basic economic environments, or seasons.
Okay, 4 seasons.
Season 1, rising growth and rising inflation, inflationary boom. Season 2, rising growth and falling inflation, disinflationary boom. Season 3, falling growth and rising inflation, stagflation like the 1970s. Season 4, falling growth and falling inflation, deflationary bust like the Great Depression or 2008.
And the goal is to own assets that do well, or at least okay, in each of those different seasons. So something is always working, or at least buffering the portfolio.
Precisely. It's about achieving risk parity, where each type of economic risk contributes roughly equally to the portfolio's overall volatility. For example, stocks and corporate bonds tend to do well when growth is rising. Government bonds usually do well when growth is falling and inflation is falling, deflation. And commodities and gold tend to do best when inflation is unexpectedly high. TPS also help with inflation.
So by combining these assets that behave differently in different environments,
You create a portfolio that is much less dependent on any single economic outcome. No single season can completely devastate your holdings.
Okay, let's get specific. What is the actual all-seasons asset allocation that Dalio revealed for the average investor seeking this kind of stability?
Based on his principles of balancing these economic risks, the allocation he shared looks like this. Only 30% in stocks, significantly less than the traditional 60%.
30% stocks.
Okay. Then, 40% in long-term U.S. Treasury bonds. These are the main diversifier when stocks fall.
40% long-term bonds. That's a big chunk.
Yes, it provides the primary ballast against stock market risk.
Yeah.
Then, 15% in intermediate-term U.S. Treasury bonds.
15 intermediate. So 55% total in bonds.
Correct. And finally, for inflation protection and diversification, 7.5% in gold and 7.5% in commodities.
So 30 stocks, 55 bonds, split long intermediate, 7.5 gold, 7.5 commodities. That adds up to 100%.
That's the simplified all-seasons allocation he shared.
And the performance. Does this super diversified, lower stock approach actually deliver decent returns? Or is it just about safety?
This is what's so compelling. It delivered both. The source has analyzed this strategy over a very long period, roughly 40 years, from 1974 through 2013. Over that time, it generated average annual returns of nearly 10%, specifically 9.88% after estimated fees.
Almost 10% a year, with only 30% of stocks. That's impressive.
Very impressive. But here's the kicker. The safety was extraordinary. The portfolio made money in 85% of those years.
Made money 85% of the time. Wow.
And in the few years it did lose money, only 6 losing years out of 40. The average loss was incredibly small, just 1.47%.
Less than 1.5% average loss in down years. That's incredible stability.
It's designed for stability. And the ultimate stress test, of course, was 2008.
Right. The global financial crisis. The S&P 500 crashed, what, 37% that year?
37% wiped out in the main U.S. stock market index. The all-seasons portfolio, during that same horrific year, it was down only 3.93%.
Minus 4% versus minus 37%. That is a world of difference.
It's night and day. And that difference isn't just financial, it's psychological. When the market is imploding and your friends are losing 30–40%, the overwhelming urge is to panic. Sell everything. Lock in those catastrophic losses at the worst possible time.
But if your portfolio is only down 4%,
you can handle that. That minimal volatility provides what one source called crucial emotional scaffolding. It prevents you from making that single emotionally driven catastrophic mistake that can derail your entire financial future. It keeps you in the game.
Okay, so we have the mindset, we're avoiding the myths, and we have a core strategy with asset allocation, potentially like the all-seasons model for stability. Now, how do we make this happen faster? How do we accelerate the journey to financial freedom?
Great question. Once the foundation is solid, there are absolutely ways to pour some rocket fuel on the fire. It mainly comes down to two things: saving more and being more tax efficient. Let's start with saving more, specifically by cutting expenses. Hashtag tag 4.1, speed it up by saving more and cutting expenses. We often think big picture, but behavioral finance teaches us that small, seemingly insignificant leaks in our spending can have a massive cumulative impact. This brings us to the concept of the latte factor.
Ah, yes, the latte factor, popularized by David Bach, right? The idea that small daily purchases add up.
Exactly. It's a metaphor, obviously, not just about coffee. It represents all those small, often unconscious daily expenditures that we barely notice.
That $4 fancy coffee, the $7 sandwich instead of packing lunch, the $2 soda from the machine. We tend to dismiss them because, it's just a few bucks.
Right, a drop in the bucket. But compounding works on spending too, just in reverse. Let's run the numbers quickly. That $4 a day coffee habit, that's $4,460 a year. Now, what if instead of drinking that coffee, you invested that $4,460 every year? Assuming a pretty conservative 6% annual return over 20 years, you're not just out $4,460 a year. You've effectively drunk away over $56,500 in potential savings.
$56,000 from a $4 coffee.
Compounded over 2 decades. Now, what if your daily latte factor is more like $10? Maybe it's the coffee, plus a snack, plus an impulse buy online. That's $3,650 a year.
Okay.
Invest that $10 a day instead. Over 20 years at 6%. You've sacrificed over $141,250.
Wow. That could be a house down payment. Or a full college education. Bond, one small purchase at a time.
It's incredibly powerful when you see the long-term impact. So step 1 for acceleration. Ruthlessly examine those small habitual leaks.
Well, while plugging the small leaks helps, the real acceleration, the big boosts, probably come from tackling the big expenses, right?
Absolutely. Cutting small things is good discipline. But optimizing the big rocks in your budget is where you find serious cash flow to redirect into your freedom fund. Housing is usually number 1. The sources highlight the massive savings from aggressively paying down your mortgage. Just adding an extra $270 per month to a typical 30-year mortgage can potentially cut the loan term down to 15 years. You own your home free and clear twice as fast, and you might save close to 50% on the total interest paid over the life of the loan. That's huge.
That's definitely low-hanging fruit if you can manage the extra payment. What else? Cars?
Cars are another big one. We often tie our ego to our car. There was an anecdote about someone's son who finally traded in his expensive, coveted BMW for a much more modest, fuel-efficient car. He realized the fancy car was just feeding his ego, costing a fortune in payments, insurance, and gas. The real joy he found came from the financial peace of mind and having extra money to save for a house, challenging those big lifestyle choices.
And this ties into the idea of lifestyle optimization too, right? Thinking about where you live.
Yes. This is a massive lever most people don't even consider. You can effectively give yourself an immediate 10%, 20%, even 30% raise just by strategically choosing where you live.
How does that work?
By reducing your cost of living. Moving from a super high-cost city like, say, San Francisco, to a still desirable but less expensive city like San Diego could instantly cut your housing costs by 30% or more.
And that difference goes straight to savings and investments.
Straight into the Freedom Fund, turbocharging the compounding, or think about moving to a state with no income tax. Or even internationally.
Like becoming an expatriate.
For retirees or remote workers, moving to certain countries, maybe Portugal, parts of Latin America, Southeast Asia can drastically cut costs for housing, healthcare, and daily living, while also potentially lowering taxes. That geographical arbitrage frees up significant capital to accelerate your financial independence timeline.
Oh.
Hashtag tag 4.2, speed it up with tax efficiency, Roth and PPLI. Okay, so saving more is one accelerator. The other major one is maximizing tax efficiency. The world's smartest investors are absolutely obsessed with minimizing their tax drag, because taxes are often the single biggest expense over a lifetime.
It's not what you earn, it's what you keep.
Exactly. And when you look at the current fiscal situation, I mean, the U.S. government debt is astronomical, something like $17 trillion mentioned in the sources, and likely higher now.
Yeah, that number keeps going up.
It seems like a pretty safe bet that taxes are more likely to go up in the future than down. So the smart move is to shield as much of your growth from future taxation as possible.
Which leads us to the power of Roth accounts.
The Roth IRA and Roth 401k are incredibly powerful tools for the average investor. The deal is simple. You contribute money after you've paid income tax on it today.
So no upfront tax deduction like a traditional IRA or 401k.
Right, you pay the tax now. But the huge advantage is that all the growth inside that Roth account, all the compounding, all the interest, dividends, capital gains, and remember, the growth is where the real wealth is built over decades. It all comes out 100% tax-free in retirement, forever.
Tax-free growth and tax-free withdrawals. That's huge, especially if you expect taxes to be higher later.
It's massive. If your investments earn, say, 7% per year inside the Roth, you keep all 7%. In a taxable account, you might only keep 5% or 6% after taxes slice off their share each year or upon withdrawal. For most people, maximizing Roth contributions should be step 5, right after setting up their Freedom Fund and basic allocation. Get that compounding engine running tax-free.
Okay, Roth is great for most people, but what about higher income earners? Often, they make too much to contribute directly to a Roth IRA, and maybe they've maxed out their Roth 401k. Are there other tax-advantaged strategies the wealthy use?
Yes, for the ultra-affluent and very high-income earners, there's a more complex strategy often referred to as the rich man's Roth. It involves using a specialized type of life insurance structure called private placement life insurance, or PPLI.
PPLI sounds exclusive.
It is. It generally requires significant investment minimums, often millions, and is really only suitable for accredited investors with complex needs. The New York Times even called it an insider's secret for the affluent.
So how does it work? Why is it so tax-advantaged?
In essence, you're wrapping a customized portfolio of investments, potentially, including things like hedge funds or private equity, that aren't normally allowed in standard accounts inside a compliant life insurance policy chassis. This structure unlocks potentially 3 layers of tax benefits, similar to a Roth, but often on a much larger scale.
3 layers? What are they?
First, like a traditional annuity or IRA, all the investment gains inside the PPLI, policy interest, dividends, capital gains, grow tax-deferred. No annual tax bill on the growth.
Okay, tax deferral, that's standard.
Second, the policy owner can typically access the cash value growth during their lifetime through policy loans or withdrawals of basis, and these distributions are generally received tax-free, up to the amount of premiums paid, and loans are generally tax-free if structured correctly.
Tax-free access to growth, that's powerful.
And third, the most powerful part. When the insured person eventually passes away, the entire accumulated value, including all the untaxed growth, pays out to the beneficiaries as a life insurance death benefit, which is generally income tax-free.
Wow. Tax-deferred growth, tax-free access, and tax-free distribution to heirs. That sounds like a triple crown of tax avoidance.
It can be incredibly effective for transferring wealth efficiently across generations for very high net worth families. Let's revisit that example we saw to illustrate the impact. Imagine someone contributes $1 million over 4 years into an investment strategy that earns 10% annually for 40 years.
Okay, $1 million initial, 10% growth, 40 years.
If that money grew in a standard taxable account, subject to ongoing taxes on dividends and interest, plus capital gains taxes upon withdrawal, the final amount after 40 years might be around $7 million. Still great, but taxes took a big bite.
$7 million after tax, okay.
Now, wrap that exact same investment strategy inside a PPLI structure. Because you avoid the annual tax drag on growth and the distributions are tax-free, that $1 million grows to just over $30 million.
$30 million. Compared to 7 million, that's
Yeah.
more than 4 times as much.
A 400% increase in the net outcome, purely due to the tax efficiency of the PPLI wrapper. You avoided paying taxes on something like $23 million of compounded growth. It's a strategy the super rich use to legally shield massive amounts of investment gain from taxation. Hashtag tag 4.3, creating guaranteed lifetime income. So we've talked about growing the money faster. But eventually, for most people, the goal shifts from accumulation to distribution. How do you make the money last, especially in retirement?
Right. The how much is enough question and how to make sure you don't run out. This feels like a major source of anxiety for people.
It absolutely is. We're facing a retirement crisis, largely because the old system of defined benefit pensions, where the company guaranteed you an income for life, is basically gone for most private sector workers.
We're all captains of our own retirement ships now.
Exactly. And the biggest danger that ship faces is longevity risk, the very real possibility of outliving your savings, especially as people live longer and longer.
And the old rules of thumb for retirement withdrawal, like the 4% rule, they don't seem reliable anymore.
The 4% rule. The idea you could safely withdraw 4% of your starting portfolio value each year, adjusted for inflation, and have it last 30 years, is now widely considered outdated, even dangerous by some experts.
Why? What broke the 4% rule?
It was based on historical market returns that might not repeat, and more importantly, it's highly vulnerable to sequence of returns risk.
Sequence risk, meaning the order in which your returns happen matters.
Hugely. If you happen to retire right before a major market crash, like in 2000 or 2008, and you start withdrawing 4% while your portfolio value plummets 30% or 40% in the first few years, you can cripple your portfolio's ability to recover. You're selling assets low to fund your withdrawals. One study showed that if you retired in the year 2000 using the 4% rule, you had a shocking 71% chance of running out of money within 30 years because of that early market downturn.
71% chance of failure. That's terrifying.
Yeah.
So if the 4% rule is broken, what's the alternative for creating reliable income?
This brings us back to a product category that often gets a bad rap, sometimes deservedly due to high fees and complexity in certain products, but which serves a crucial purpose: annuities. Specifically, using them for income insurance.
Annuities. People have strong opinions about them.
They do, often negative, usually focused on high-cost variable annuities pushed by commissioned salespeople. But the concept of an annuity at its core is about pooling longevity risk to provide a guaranteed income stream you cannot outlive, essentially a personal pension.
Framing it as income insurance or a paycheck for life sounds different.
It resonates differently. Studies have shown this. Offer people a product called a savings account. Maybe 20% are interested. Offer the exact same financial structure, but describe it as providing a guaranteed income for the rest of your life, a paycheck that will never run out. Subtly, 70% or more are interested. People crave income security in retirement.
So certain types of annuities can provide that security. Which ones are generally used for this?
Simple fixed annuities, or those FIAs we discussed for principal protection, can be structured to pay out a lifetime income. But one particularly powerful tool, specifically designed to combat the fear of outliving money late in life, is longevity insurance, often using deferred income annuities, DIAs.
Longevity insurance, how does that work?
It was basically insurance against living too long and running out of funds in your 80s or 90s. Here's how it might work. A 65-year-old couple, maybe planning for a 30-year retirement, takes a portion of their savings, say $100,000, and buys a DIA.
Okay, $100K lump sum at age 65.
That money is locked up. They can't touch it. But the insurance company guarantees that if they are still living at, say, age 85,
20 years later,
that DIA will start paying them a substantial, guaranteed annual income for the rest of their lives, no matter how long they live, because the insurance company pools the risk. They benefit from those who buy the policy but don't live to 85. They can offer highly leveraged payouts to the survivors.
How leveraged? Like, what kind of income could that $100K at 65 generate starting at 85?
The numbers can be quite impressive. Depending on interest rates and the specific product, that $100,000 invested at 65 might generate a guaranteed payout of close to $64,000 per year starting at age 85 for as long as either spouse lives.
$64,000 a year, guaranteed from age 85 on, from a one-time $100K payment 20 years earlier.
Yes. It provides immense peace of mind about late life expenses like healthcare, but the strategic benefit is even bigger.
What's the strategic benefit?
It dramatically shortens your planning horizon for the rest of your portfolio. By guaranteeing that your essential income needs are covered from age 85 onwards, you now only need to make sure your primary investment assets, your stocks, bonds, real estate, last for 20 years, from 65 to 85, instead of potentially 30 or 35 years.
Ah, I see. It reduces the pressure on the main portfolio and lowers that sequence of returns risk because the timeline is shorter.
Exactly. It makes the overall retirement income plan much more robust and less vulnerable to market volatility over an extremely long period. It's a smart way to hedge against the financial risk of a long and healthy life. Hashtag tag outro post.
Wow. Okay, we have really covered a huge amount of ground here. We've gone from the absolute foundation, that psychological commitment, changing your story all the way through, to sophisticated strategies the billionaires use, like asymmetric risk, the all-seasons portfolio for stability, and advanced tax planning. It feels like you, the listener, now have the map. You understand the mental toughness required, and you've seen the power of the engines like compounding and proper diversification.
And just as importantly, we've shown a bright light on the financial landmines you need to avoid, those deceptive hidden fees that can literally steal half your future wealth, the misleading performance numbers, and the critical danger of working with a conflicted broker instead of a true fiduciary. Financial mastery fundamentally comes down to understanding these rules, the ones that help you and the ones designed to trip you up, and then applying them with unwavering consistency, discipline over decades.
But let's bring it back home. The ultimate goal here. It isn't just about accumulating the biggest possible number in your account, is it? It's about what that number enables. As Henry David Thoreau put it, wealth is the ability to fully experience life.
Beautifully said. Which leads to the final step in the blueprint the masters often emphasize. Giving back. Using your resources not just for yourself, but for others.
Giving back, why is that part of the financial plan?
Because it creates this incredible virtuous cycle. It's not just altruism, it benefits the giver immensely. Study after study in psychology and neuroscience shows this. People consistently report being significantly happier, having genuinely better moods when they spend money on others, even small amounts like $5 or $20, compared to spending that same money on themselves.
Giving literally makes you happier.
Happier and, fascinatingly, even healthier. There's a documented link between generosity and well-being. So as you master your finances, you gain more freedom, more capacity to engage in this incredibly rewarding act of giving.
Okay, so final thought to leave our listeners with, something provocative to mull over.
Well, think about this. As you're diligently applying these financial principles today, saving, investing wisely, protecting your assets for the long term, you're doing more than just planning for retirement as we currently know it. You're positioning yourself to benefit from another form of exponential compounding that's happening all around us, the compounding of technology.
Technology compounding.
Right.
Like Moore's Law.
Exactly. But across many fields, Ray Kurzweil, the futurist, talks about this constantly. His core idea is almost deceptively simple. Live long enough for the technology to catch up.
Meaning?
Meaning, the breakthroughs happening in areas like biotech and nanomedicine, artificial intelligence, they are accelerating at an exponential pace. Think 3D printing of replacement organs, advanced stem cell therapies reversing aging damage, AI diagnosing diseases far earlier than humans can. The potential quality of life and potentially the duration of healthy life could increase dramatically in the coming decades.
So mastering your finances today.
It is essentially buying yourself the ticket to participate in that future. By protecting and growing your assets, by ensuring you have the resources not just to survive but to thrive long term, you give yourself the best possible chance to benefit from these potentially limitless possibilities that future technological breakthroughs might offer.
Start rich today by appreciating what you have, commit to the discipline, build the wealth, and position yourself for a future that might be longer and healthier than we can even imagine. That's a powerful thought to end on. Thanks for joining us on The Deep Dive.